Sources of long-term funds. Firm needs long-term funding to finance expenditures on fixed assets, the buildings and equipment needed to conduct their businesses. They may seek long-term funds through debt financing, that is, from the outside the firm, or through equity funding by drawing on internal sources. We'll discuss both options in this part of our studies, as well as middle ground called hybrid financing. We also analyze some of the options that enter into decision about long-term financing, as well as the role of risk-return relationship in attracting investors to a firm. Debt financing. Well, the long-term borrowing, as we talk about the uh, long-term borrowing from sources outside company, debt financing is a major component of most firms' long-term financing planning. Long-term debts are obligations that are payable more than 1 year after they are originally issued. The two primary sources of such fundings are the long-term loans and the sale of corporate bonds. Long-term loans, most corporations get long-term loans from commercial banks, usually those with whom they have developed long-standing relationship. Credit companies such as Household Finance Corporation, insurance companies, and pension funds also grant long-term business loans. The long-term business loans, uh, as they are established by these companies, are attractive to borrowers for several reasons. They are attractive because the number of parties involved is limited. Loan can often be arranged very quickly. Number two, the firm need not to make public disclosure of its business plans or the purpose for which it is acquiring the loan. In contrast, the issuance of corporate bonds requires such disclosure. Number three, the duration of the loan can easily be matched to the borrower's needs. If the firm needs change, number four, if the firm needs change, loans usually contain clauses making it possible to change terms as well. Well, the long-term loans also have some disadvantages. Borrowers, for instance, may have trouble finding lenders to supply large sums. Long-term borrowers may also face restriction as conditions of the loan. For example, they may have to pledge long-term assets collateral or agree to take on no more debt until the loan is paid. Interest rates. Interest rates are negotiated between the borrower and the lender. Although some bank loans have fixed rates, others have floating rates tied to the prime rate, and the bank charges its most creditworthy customers accordingly. A loan at 1% above prime then is payable at 1 percentage point higher than the prime rate. This rate may fluctuate or float because the prime rate itself goes up and down as market conditions change. Corporate bonds. Well, as we have already studied, that a corporate bond, like commercial paper, is a contract, a promise by the issuer to pay the holder a certain amount of money on a specified date. Unlike issuers of commercial paper, however, bond issuers do not pay off quickly. In many cases, bonds may not be redeemable for 30 years. Also, unlike commercial papers, most bonds pay bondholders a stipulated sum of annual or semi-annual interest. If the company fails to make a bond payment, it is said to be in default. Bonds are the major source of long-term debt financing for most corporations. They are attractive when firms need large amounts for a long period of time. The issuing company also gains access to large number of lenders through nationwide bond markets and stock exchanges. On the other hand, bonds entail high administrative and selling costs. They may also require stiff interest payments, especially if the issuing company has a poor credit rating. Bond indentures. The terms of a bond, including an amount to be paid, The interest rate and the maturity date, the date when the principal is to be paid, uh, will differ from company to company and issue to issue. They are spelled out in the bond contract as bond indenture.